I'd love to hear how long, I think this is the most important aspect as you highlight that what's happening to the cost of money and interest rates. And I'd love to hear your thoughts on how long is higher for longer and how high is high. Let's get into the details. Where do you see this going and why? Hold your feet to the fire so we can measure this down the road as well.
Yeah, well, the current state that we're in with interest rates, let's say at 4.5%, and income growth the way that it's growing, and basically interest rates have been here, roughly for the last 2 years, give or take, 18 months, 2 years. So we've had elevated interest rates for an extended period of time, and nonetheless, we've had 7 quarters of at or above potential sort of total domestic demand, getting around the sort of wiggles of the way that GDP is accounted for. And so what I'd say is in many ways right now, in this current environment, we're in a bit of a stasis, a sustainable stasis environment where you can continue to have, income growth the way that it is. Interest rates aren't high enough to create enough of a drag in the economy, to slow down spending, to slow down asset prices. And this can continue for an extended period of time. The main issue with this current environment is not growth. Growth is fine. The main issue is inflation's too high, and that the amount of nominal spending that's occurring in the economy is just too high relative to the amount of productive capacity growth in the economy. And so while we've made a lot of progress on inflation relative to the sort of supply chain driven inflation that happened, a couple of years ago, we're stabilizing. We've seen over the course of the last 6 months, we're stabilizing at a rate of inflation that's too high, inconsistent with the Fed's mandate. And so when I think about this problem and how long can it persist, it's less about a time frame, a calendar time frame, and more about a set of linkages. What needs to happen in order to create a slowdown and in order to curb inflation? And what needs to happen there is you have to have, if we have an income-driven expansion, then what has to happen is spending needs to slow. Well, what will cause spending to slow? What has to happen is asset prices have to shift. So households have to become more fearful. Right now, if you're a household, you're like, my 401k is booming, my house is booming, my stock account is booming. Like, why should I save more? Right? So what has to happen is assets have to start to decline in value in order to shift away from spending out of existing income. And then the question is, how do you get asset prices to fall? Well, it basically has to happen one of two ways. Either you get an exogenous, unexpected shock that none of us are planning for, or you have to have a sufficient tightening of financial conditions to start to drag on asset prices. So that means either the Fed's got to do it, or essentially the bond market has to do it on its own. And so that set of linkages, it's less of a temporal thing and more an order of the linkages, which is first yields rise, then asset prices fall, then spending slows, then earnings slow, then you get layoffs and decreases in wage income, and then that creates the negative spiral that eventually brings inflation down to target. But so far, the Fed certainly doesn't seem to be doing the work. And the long end of the bond market seems to be constrained a bit by the Fed not doing the work, as well as the fact that there's easings in global jurisdictions. And so that's creating, that's creating pressure, dragging the U.S. bond market, the U.S. bond yield down relative to the strength of the domestic economy.